This paper was motivated by a set of questions that we are interested in related to the role of institutions and asset markets. So for example, we know from like the last paper and the literature that institutions have become more important over the years as a share of the market that they manage. How's that affected the liquidity of asset markets? There's been a lot of QE activity going on throughout the world. Right now, the Euro QE program is kind of on the forefront. How does QE affect liquidity and volatility in asset markets? Should large institutions like BlackRock and Fidelity be designated as systemically important, and should we regulate them as such? So that was a question that was raised by the OFR report in 2013. So the purpose of this paper is to kind of develop a framework to answer these types of questions, and it kind of builds nicely on the last paper that we just saw. So the questions like, we think about institutions, and we have lots of data about institutions now. So like John Llewellyn has done nice work using 13F data. So how do we use like data like 13F or bond holdings, or in the Eurozone we have great data on institutional holdings from the ECB. How do we use such data to do equilibrium asset pricing? So our contributions are to develop a new demand system for financial assets, where we're going to think about institutional demand for assets as a function of prices and characteristics. So kind of very much in the spirit of what Ken and Fama and French have done over the years, but trying to make it, merge it with holdings data and try to estimate demand functions. Our framework is going to match institutional holdings exactly, and we're going to see that there's going to be a lot of heterogeneity in demand across institutions that you wouldn't see if you aggregate them up into like one big institution. Our framework is going to be consistent with traditional asset pricing with either heterogeneous beliefs or constraints. We're going to try to identify our demand system by IV or coefficient restrictions. And I'm going to show you some applications of our framework towards the end of this talk. To jump right into the model, the framework we're thinking about is we're going to model each institution as having a portfolio choice problem where they're allocating across different assets. And suppose there's n different assets in the economy, and each institution I is going to allocate across a subset of those assets that they're going to be intensive on. Each investor I's demand for asset n is going to be given by a logit function, where this function is a convenient functional form where there's going to be adding up constraints. So the portfolio shares add up to 1 is what you want. And moreover, the shares are going to be positive. The positive restriction is not necessary. So we can have functions that add up to 1 but can take on negative values. But the reason the logit function is in the 13F data, we don't observe short positions. So we wanted a functional form that is strictly positive, but that's not like critical in our framework. But what's kind of important is that we're going to model this demand function as a function of prices and characteristics. So here's the log price. Here are characteristics that could be things like dividends, earnings, book equity, assets. You can throw in your favorite characteristics here. And then epsilon is what we call latent demand. So this is like the unobserved demand of institution I for asset n. And then the other equation that we have in our model is just market clearing. So if you aggregate demands across all institutions, they have to add up to shares outstanding times price. So this is market clearing in dollars, right? So price per share times shares outstanding is equal to the dollar value of stock n, or asset n, aggregated across all institutions. Now, turns out that our demand system has a unique equilibrium as long as the coefficient on price is less than 1, which is equivalent economically to saying that demand functions are strictly downward sloping. So I'm going to show you that our framework is consistent with traditional asset pricing and portfolio choice, where we want heterogeneity in demand. So we want the portfolio separation theorem to essentially fail. So we need something like heterogeneous beliefs or constraints. The fact that we're studying institutions suggests that these investors could be strategic, so they're not going to take prices as given. So we want to explicitly build into our framework potential price impact. And it turns out that if assumption about factor structure and returns is kind of critical to going from like standard mean variance demands to a characteristics-based demands, as you'll see. Okay. So the way we traditionally do asset pricing is we start with an objective function. Like in this case, we're maximizing expected log utility over terminal wealth at time t. And the choice problem is you're choosing a vector of portfolio shares. Now the standard budget constraint is your wealth, and the future is your wealth today times the rate of return in your portfolio, where R is the vector of gross returns and W is the vector of weights on those returns. And then 0 just indicates the risk-free asset. So we know like very well from standard portfolio theory that the optimal portfolio is going to be a mean variance portfolio, so sigma inverse, the inverse of the covariance matrix of returns. And mu is the vector of expected returns. But here I noticed that I index expected returns by I because this is a model with heterogeneous beliefs, so each institution could have different beliefs about returns. Now, you notice that with log utility, it's just going to be sigma inverse mu, but I have this extra term in the denominator that looks like risk aversion. The reason that happens is if investors are large and they care about price impact, they're effectively going to be like having risk aversion. And this, it turns out that this term constant C is going to be 1 plus A is how big you are, your assets under management, divided by a weighted sum of assets under management of all the other investors. So if I'm large relative to other investors, it's like effectively like I'm more risk averse, and my demand curves are going to be more downward sloping. Okay, so but the special case of is when my assets go to 0, so I'm atomistic. That's the sort of the classic asset pricing paradigm, which investors are price taking. Then this constant just becomes 1, which is a standard mean variance. Okay, so now how do I go from mean variance to like a characteristics-based demand function? So the key assumption that does all the work is this assumption, which is so assume that the covariance structure has a covariance matrix has a factor structure where the covariance matrix is given by a vector pi inverse plus scalar times the identity matrix. So this is like saying, like in the CAPM world, this is just going to be a vector of betas, and little pi is going to be idiosyncratic volatility. Now, moreover, I'm going to assume that expected returns and these factor loadings are going to be linear in prices and characteristics. So this is like a linear version of like Fama-French, where expected returns and factor loadings are just functions of characteristics like book to market size and so on. So this assumption turns out to be very powerful because with some math you can show that the demand function is going to be a function of prices and characteristics plus what I call latent demand, which is the individual specific deviation from expected returns, that the part of expected returns that depend on characteristics. So these are, think of it as unobserved characteristics to the econometrician. Okay, so this vector beta is going to be a function of phi and psi, right? So phi is the vector that determines how characteristics impact expected returns. Psi is a vector that determines how factor loadings depend on characteristics. So beta is a linear combination of this phi and psi. So economically, what does this say? Well, it's not the case that when we invest, it's not like we care about characteristics directly. We care about characteristics to the extent that they either forecast expected returns or factor loadings. So this demand function is saying that I like assets whose characteristics are associated with either high expected returns or low factor loadings, which is exactly what you would think intuitively. Okay. So ultimately, what we derive is a demand function where you go from mean variance to a characteristics-based model. And once we have this model, then we can do equilibrium asset pricing. So the data we're using is a 13F data set where since 1980 we have the quarterly stock holdings of all the institutions that are managing over 100 million. This is merged with the standard CRISP CompuStat database, and we end up with 44 million observations, which is the number of assets times the number of years, times essentially the number of holdings per institution. So this is like an example like big data in economics as applied to finance. So this is not like much bigger data than we typically use in finance, where we only look at prices and characteristics. Now the key facts is that the share of the US stock market, institutions used to manage about 35%, which has expanded to 63% at the end of our sample. And in 2014, the median institution managed about 300 million and held about 69 stocks. So to give you an idea, like the cross-section of stocks, like 3,000 to 4,000. So these guys hold very concentrated portfolios. Now, our empirical specification is if we take our demand function and then work in logarithms, then log demand for stock n or asset n is a function of log price, log characteristics, and latent demand epsilon. So this almost looks like a linear regression model that almost invites you to just estimate this thing by OLS. Now, what we're trying to identify is like a demand system, and this is like for a single institution from the cross-section of stocks they hold. But you can do this for each institution I. So different institutions are going to have different preferences for characteristics versus price elasticities. So the characteristics that we throw in here are things like log dividends, log book equity, profitability, but you can presumably put in anything you want here. And we estimate these coefficients for each 13F institution at each point in time. So it's like a large exercise in parallel computing where we have 3,000 institutions and you do that at each point in time. Now you have like the whole demand system for the entire US stock market, and with the whole entire demand system, you can start to do some interesting applications. Now before I go there, let me explain to you how we identify this demand system. So as I mentioned already, suppose you do this by OLS, then the concern is that the latent demand, the part of demand that's unobserved to the econometricians, potentially correlates with prices. The reason being that if I'm large, right, and I demand a share n, I could push up the price of share n, so epsilon n, and prices are going to be correlated. Okay, so one way to get around this problem is we can put restrictions on the demand system that gives you over-identifying restrictions and allows you to ultimately estimate this with weaker assumptions. So one reasonable assumption is that it's not like we care about prices per share directly. We care about prices in relation to characteristics like dividends per share. So suppose the demand system only depends on the log price to dividend ratio, then essentially that gives you a one coefficient restriction, which is the coefficient on log price and log dividends have to be opposite and equal. So you get rid of one coefficient, then you can get rid of price from the moment condition and estimate this by restricted least squares. Now this log dividends isn't anything special. You can kind of do it with any kind of characteristics. So you can do it with log book equity per share or cash flow per share. But more generally, you can put in the coefficient restriction would be price together with a bunch of characteristics. Their coefficients have to sum up to 0. Right, which is it's like saying valuation ratios are what matters in demand. A different assumption comes from is an IV assumption, where this comes from the index addition deletion literature, like a la Schleifer-Vishny, or Schleifer 86, sorry, where you assume that investors have an exogenous investment universe. So think about this as like pension funds can only invest in a set of stocks, and they try to decide between those stocks. And suppose the investment universe of investors outside my group, so let's say if I'm an insurance company, I don't care directly about the investment universe of mutual funds and hedge funds. Suppose you can take that as exogenous, then you can rewrite market clearing as price times shares outstanding is the sum of demand across all investors, where I group the investors into investors that are similar to me and ones that are dissimilar to me. And among those that are dissimilar, I break it up into the intensive margin, how I allocate within the investment universe versus how I allocate within the investment universe. Take the part that's exogenous and clear markets with that part of demand. This gives me an instrument for price. So this is like the counterfactual where suppose like I'm an insurance company and there's other institutions whose demands I don't directly care about, but the fact that they are in some asset markets pushes up the price. That's going to be an instrument for my price when I estimate my demand function. Okay. So to give you an idea of like how least squares gives you a very different estimate for IV, for each institution at each point in time, this dot represents their coefficient on price estimated by least squares versus IV. So if IV and OLS gave you the same estimates, then all the points should line up along the 45. But notice all the points are actually above the 45, which suggests that least squares, OLS, gives you a positive bias relative to IV. So this is exactly what you would expect in the presence of price impact, is that prices and demands are going to be positively correlated. So that gives you a positive bias if you estimate this by OLS versus IV. Now the coefficient restriction and IV give you very similar estimates. So notice these dots line up along the 45. Now we have an entire demand system. We can do something like, well, we can estimate liquidity. So one liquidity measure that's often used in the microstructure literature is like an estimate of like what's called Kyle's lambda, which is in our framework how prices vary with investorized demands. Now this figure summarizes our estimates of price impact for the average institution, and this line is the median stock. So when the average institution traded the median stock back in 1980, you get a price elasticity of 0.02, which means if I increase my demand by 10%, then I move prices by 20 basis points. Okay. Now these are the least liquid stocks in the cross section, and these are the most liquid. Right? So the most liquid stocks have always been liquid. You can trade those with very little price impact. But the least liquid stocks, well, there used to be a lot of price impact to trade these stocks, but notice that this distribution has collapsed over time. In other words, even the least liquid stocks are a lot more liquid now than they used to be. So you notice this big trend. Now you also notice the cycle here. So like price impact went up during the crash of the dot-com bubble, right? So this like markets become less liquid here. You notice the financial crisis here, markets become less liquid. So there are cycles in liquidity and also this trend in liquidity. Okay. You can also use our framework to decompose the variance of stock returns into kind of like supply factors versus demand factors. So our model says that prices are entirely determined by shares outstanding, characteristics, assets under management, these coefficients on characteristics, or like preferences for characteristics, and this latent demand. Okay, so using the definition of log returns, we can see, well, when prices move, then is it caused by characteristics changing, so like kind of news about earnings and profitability and so on, or is it coming from institutions trading for reasons that are orthogonal to these characteristics? So when we implement this variance decomposition in the cross-section, 2% of the cross-sectional variance in stock returns is explained by changes in shares outstanding from year to year, 6% by characteristics, 14% by changes in assets under management. So this is like saying when assets move from BlackRock to like hedge funds and so on, how much is that contributing to volatility of stock returns? That's 14%. But ultimately, 74% of the variance in stock returns is explained by latent demand. So this is like institutions trading for reasons that are orthogonal to characteristics that are in our specification. Finally, we use a framework to predict stock returns. So to think about like using our demand system to create a trading strategy in the cross-section. So one trading strategy is that, well, there are going to be stocks where institutions demand a lot. Right? So those are going to have currently high prices. As demand's going to mean revert, you expect low returns. On the opposite side, there are stocks that institutions like have very low epsilon or low latent demand or low demand on. Right? As demand mean reverts, prices are going to go up. Those stocks are going to have high returns. Okay? So this is like a large sample version of like some stuff we've seen like the mutual fund literature. Like so, for example, like the Koval Stafford mutual fund fire sales. So if you can forecast changes in institutional holdings, you can try to create a strategy that exploits that. But this is like doing it for the entire 13F universe. So during our sample 1980 to 2014, an eco-weighted strategy that exploits this mean reversion in institutional demand generates a 17% annual return, and value weighted is about 6%. So predominantly this mean reversion in institutional demand you can exploit mostly on smaller stocks, because for larger stocks, right, the fact that demand mean reverts is not going to affect their price movements as much. So in conclusion, the goal of this paper is to kind of like, instead of taking like the 13F data as like one aggregate big fund, we want to kind of like go the opposite way, start analyzing like each sector at a time. So mutual funds, hedge funds, pension funds, insurance companies, they're very different institutions. And even within those classes, there are different size institutions, have very different strategies. And that implies that like the asset demand of these different institutions are going to be very heterogeneous and rich. So we want to like respect that heterogeneity and then do asset pricing by aggregating those very heterogeneous demand functions. Ultimately, we're interested in this framework because we can answer questions that are very difficult with sort of reduced form regressions or event studies. So one of our ongoing projects that's developed out of this paper is the ECB has amazing data on institutional holdings all across the Eurozone. So we can see in real time as the ECB does QE, which institutions are selling to QE and which assets are they substituting into. And we can estimate the impact of QE not only on risk-taking in the institutional asset space, but also the price impact in different securities markets. Some work that Ralph and I have done on insurance companies is also kind of along this framework. So if you regulate insurance companies as systemically important institutions, how does it affect corporate bond markets where they're the largest players?